Hello. Thank you for tuning in to our Invest Charlotte 2023 launch conference. You're about to watch panel number 3, Current Climate, where our financial leaders talk about today's economic landscape. Enjoy.
Well, thank you, everyone. My name is Rakesh Gopalan. I'm a partner at McGuire Woods. It's a law firm. I'm a corporate and securities lawyer, and I coach our fintech practice. So that's sort of my tie-in to some of the topics we'll be talking about today. Great couple panels so far. I'm not a Charlotte native, but I've been here 17 years, so I think I'm very close to getting that card, at least by being here so long. So thank you, everyone, for being here. The last year has been very volatile for the financial industry. Can you all contextualize what's happening today and where we should expect downstream impacts on local and other community institutions?
I guess I'll go first since I'm sitting right here. Everybody's been reading the Wall Street Journal, New York Times. Everybody knows what's going on with interest rates and things like that. I would say that actually the financial sector is pretty strong. I mean, we've had some instances where we've seen some failures of banks, but most banks have actually done really well in hedging against what we all knew was going to happen. This is not the first time we've had rising interest rates. This is not the first time we've had inflation. And so in a place like Charlotte, which is the foundation of the financial sector, I think we would echo what we've heard in the first two panels, that the financial sector is pretty strong, that Charlotte is very strong and growing, and we don't imagine there's going to be a huge impact in that. Now, of course, when you say it's never going to happen, it can happen. But the reality is that most of the banks have really in a strong position, and we don't think there's going to be a ripple effect that we saw in like 2008, or even when there were higher interest rates in like the 70s.
So good morning, I'm Holly Welch-Stubbing, and I am with E4E Relief, and sort of my reason to be on the panel is to talk a little bit about the impact to low to moderate income workers in the financial sector. And in what we've seen at E4E Relief, we provide a workforce solution that provides cash payments to people in crisis. So we typically see applications, and this is global, but we see national applications from all over the country for various financial hardships. And so we have a pretty good amount of interesting data since 2020 around not only the financial volatility of the market last year, but also that combined with after effects of COVID and downstream impacts of climate change and other things that are coming together in a mix of issues that affect that population specifically with their food, housing, and transportation costs, and how that has affected everyone directly in that segment. So from our perspective, while inflation has gone down, mathematically here in the last several months in terms of percentage, the costs are sort of here to stay for a little while longer, maybe forever, in some of those core-based spaces where this population's getting hit the most.
Hello, everyone. Antoinette Tucker-Harris, and I'm with Synchrony. We are one of the largest retail card servicing companies. We back our retailers in credit for their customers. And one of the things that we have been working through our market, though we have had strong performance over the last couple of years, actually, we are preparing on the CFPB proposal around the $8 late fee and what that impact will be on our industry when you think about the way that we do business. But when you also think about our customer base and the disposable income that they have today and the upcoming student loan payments, I think those are some areas of concern that we all should be thinking about in our businesses and what impact that is going to make on our economy as we move forward.
Yeah, I would love to. Can we make this really interactive?
Sure.
Okay, great. The question was really more around, I think, like, the way I took it or answered it was more around, like, what does that mean for the sector? I could not agree more with these two women up here that, and it was touched on a little bit, I think, by Zach in the previous panel about the upward mobility issue that Charlotte has. And so while Charlotte has seen like expansive growth, there is a segment of this population in Charlotte and in the state that is not experiencing that same and live on the precipice of financial disaster. And so while the industry is doing well, there is a segment that is at peril when it comes to rising interest rates and inflation. And so that, to these ladies' response, when you talk about that, that is the real danger if this region doesn't address what happens to those who can't afford a $300 or $400 life disruption. It's not so much about the bank, and I work for a credit union. I want you to come and put your deposits with us because that's how we make money and we're able to support our members. But really, it is our members who are at most danger of being left behind in this economy. So I just wanted to diddle y'all.
No, that's a great point. Staying on some of the specific vulnerabilities of Charlotte. So we're the second largest banking city in the country, depending on how you calculate it. I think by assets, we are next to New York. What are some challenges that we have? What are some unique vulnerabilities that we have, and maybe some unique areas of resilience that we have as a city?
I'll take that. When I think about the vulnerabilities, I believe housing, definitely just how do we continue to make housing affordable? We have seen such tremendous growth around, from home building and, the growth to the city, the movement into the city. And, even some of us have benefited from the growth from housing and the increase of our properties. But I think the vulnerability that I've seen in larger markets where we're growing to is really around housing. And we should really take a step back and think through, could we eventually look like New York or San Francisco in the future as in regards to housing, and, how do we prepare for that?
I'll just echo and say the prepared answer I had was that it widens gaps. So for these financial issues, it further widens the gaps that we were talking about in economic opportunity. And, we talked about upskilling, I think, in the first panel, and creates the need for upskilling and sort of taking advantage of what this city, if we're talking about Charlotte, has to offer in terms of jobs. There's a lot of mismatches in terms of the skill set in this community, the varying diversity of industry that's here, and the necessary workers, as we've heard in, all morning. And so with the specific declines that are expected in 2023, there are sort of, economists in the area will say in 2023 that, 3 industries are prepared to decline. Those particular industries happen to be in areas with frontline and essential workers that are critical, that would have to have those upskilling, to move into and take advantage of the segment we're talking about.
Talking about interest rates, obviously there's been a lot of fluctuation, and we had several years of near zero interest rates. That has changed, and that seems to be the new paradigm. At the same time, we have in history faced interest rates at or significantly higher than where we're at. So how do you all view where we're at right now in terms of the interest rate environment and the impacts on either your clients or your customers?
I'll take that. I would say, well, I've been in banking for 20 years. When I started in banking, people had certificate of deposits at 8% interest rates. And so we're headed back there. I'm not a financial, but I believe we're headed there. And, I think that we just have to create products and utilize technology and innovation to make the cost of living more affordable. So when we think about buying a home or financing a car, where can we become more innovative in a financial institution to, fight up against inflation and interest rates to just make it affordable for people to continue to live. So I would just say we're probably headed there, and, we just have to be creative in this space as we go through, the increase of rates and back down again.
So I think I alluded to earlier that the rising interest rates hurts our customers, right? It hurts those who are at the lower wage, who do not have generational wealth, who are housing insecure, right? And they feel it in many ways. They feel it when they go to the grocery store. They feel it when they go to the gas pump. They feel it in healthcare costs, right? And those are not. They're not even thinking about buying a home because they can't find a home that they can afford that doesn't require, talk about a 10, 15-minute neighborhood. We have folks, our members, who are buying homes in other counties and driving in 50 minutes, an hour, because that's where they can afford a home, right? You look at the average house in Charlotte, you're talking about $300,000 plus. That is not a starter home for most folks. And so the rising interest rates for those folks really have an economic impact that takes years to dig out of. And that is what worries us as a financial institution. Again, we have CDs, and we love for folks to invest, and we are a mission aligned, our mission organization and credit union. So we love folks who are mission aligned because it allows us to then figure out how to come up with those creative products for those who don't have $100,000 to put in a branch and a CD to earn. We're not at 8%, anywhere close to that. We are at 4%, but they don't have that to do, but they're going to need somewhere because we've gone to a cashless society, right? How many of us have gone into a store and they don't take cash? Well, what happens if you're underbanked or unbanked, right? You are now in a position where you can't even go into a store and buy needs because you don't have a bank account. And so figuring out how to address that for those folks is really what keeps us up at night.
When I thought about this question, I decided to put, again, the social sector hat on and say, what has the social sector or the independent sector, how have they experienced the interest rate environment? And I found myself scratching my head a little bit. I mean, we can go to the programmatic side and talk about who you're serving, but I mean the business model itself of most nonprofits. How does this affect them? And the answer that I came up with was not much, because there's so little innovation in the space around supporting various business models in the sector that those kinds of economic shifts definitely affect donations, and we're going to talk about that. But beyond that, it was harder for me to think of a specific way that it interacted with the sector, which I think is a problem. I think there's such a disconnect in certain instances that there's opportunity for innovation there.
Yeah, and I think you all have done a really good job of identifying the problem and offering and explaining a little bit about what some of the solutions are in terms of innovative products. Holly, your organization in particular also offers some solutions to that. But what are some other ways that you all can think of, or can you expand on some of those solutions to address financial instability? And maybe going one step further, are there things outside of your spheres? What can just a normal everyday company do in addition to the things that the financial tools that you guys may be able to offer?
Yeah, so it was interesting in the last panel, they talked about environmental sustainability. And so we're thinking about how to make sure that low-income folks don't get left out of the greening of America, right? So what would it look like if you can afford, you don't have to buy a Tesla, right? But you can afford an EV car because the price of gas is going to a point where having and being able to plug in. But what does that mean? It means that you have to have some place to plug in your car, right? Which means that you have to be in an apartment or a multifamily or a house that has a plug, right? So how can we work with the builders? How can we work with the cities to make sure that there are electric vehicle outlets available for those who are on the lower income, because they then can also afford an EV car, right? How do you make sure that if you can't afford a $300,000 house, but you can afford a fixer-upper, that when you do your rehab, that you incorporated green elements so that you save on those utility costs over the life of having that home, right? Those are the things in terms of the financial products that I think our industry is starting to look at. and figure out a way to make it cost effective for those who are on the lower income. Those who have been on the higher income, they've put solar panels on their homes, they've put in the high efficiency, they figured it out. They can do the longer horizon for the payback. But when you're on the lower income, as well as the educational part of why does it make sense, excuse me, to do that type of investment. So that's one innovation that we've been looking at, is trying to figure out how to make that math work to connect sustainability and environmental stewardship with lower income folks.
Want me to go next? One of the things I would say is that we typically work with larger companies, and one of the things we're seeing in terms of innovation in a post-COVID world is that companies are looking at their key vendor relationships, they're looking at their supply chain, and they're looking all the way through to the workers associated with the delivery of the key components that the business needs. And I think that is in and of itself, there are some innovative things being considered there. When you get into this and study what does the low to moderate, frontline, essential, use whatever word we want to describe, they're different, but they're in the same realm of maybe need. What we're seeing is innovations in benefits and how people access benefits differently in different populations. And you see insurance companies and workforce providers looking at various ways to support populations differently, which in and of itself, I mean, obviously some of the construct of benefits legally is set up to ensure that everyone gets an equal treatment, but when you look at usage and utilization, it looks very different. And so there's quite a bit of activity in that space right now in a post-COVID world, both for your existing key stakeholder, your employee, but then those all the way through your supply chain. I do think that the dreaded ESG term, which none of us are allowed to use anymore, has been a driver. COVID combined with the idea of reporting out on what you're doing in some of those spaces has been a key driver of some of those strategies shifting.
Hello. Oh, when I think, I don't know what happened there. When I think about our company in general, just coming off the history of that, we really started off with allowing people the affordability to put appliances in their home, right? And so we created products around that from an innovation standpoint. And it's like, how do we continue to innovate in our space to allow affordability and other things, such as pet insurance? So, we offer pet insurance as a leg within our company from financing, and then also healthcare. Healthcare is one of the areas that we're really trying to tap into to think through how do we make it more affordable for folks. So we're creating products and we're going out into the economy and thinking of ways that we can tap into supporting our consumers, supporting our customers, just for like day-to-day expenses as they navigate through this challenging economy and inflation. So I would just say those are the two main spaces for us that's pretty innovative, like especially with the pets and then with healthcare as well.
Yeah, I think one of the great things about having multi-generations in the workforce and in the workplace is they push you to innovate, right? And so I'm not going to say how old I am, but I am that, technology migrator, right? Like I did not have a cell phone. I did not have access to tech. I do know the difference between beta and VHS, to give you an idea. And if you laughed at that, then we're in the same age. But when we have interns or when we have this next generation, they are pushing us to think about the way we interact with the world differently, even through our products and services, right? So we have brick and mortars because we will always have brick and mortars because of the population we serve. At the same time, we have to figure out how to serve the population that wants to be values aligned. So they are choosing companies, employers, who they do business with according to the values. but they want to do convenience, right? So they don't want to come into our brick and mortar. They want to do everything with technology, right? So how do you serve the population that needs access to someone, needs someone to talk to through complicated financial decisions, and that young person that wants to put their money where their values is, but doesn't ever need to come into your branch or never come into your store? So how do you serve both, right? That's part of that challenge for us, right? This is the folks who will be in an apartment and not have a car in a place that you're like, how the heck do you do that, right? They Uber, they have scooters, right? I have people who actually bought the scooters that everybody else just pays for with their credit card to drive 3 blocks. They have them in their apartments and they use that as a major mode of transportation, right? So how do you figure out how to build housing and finance housing that looks very different, that looks like co-op housing and cooperative housing and multi-generational housing? So it's really interesting to have that generation be in our workforce and saying, well, that product wouldn't work for me. And us go, well, what do you mean it wouldn't work for you? And then they start to tell us, and we all, first, we're all like, what? And then we say, okay, let's think about how we do things differently. And so I think you're going to see a sea change in a lot of different models as we start to listen to that generation more and more, incorporate them into product design and service design.
So keying off that, in terms of credit union membership has been rising steadily.
It's because we're amazing.
So what do you think is attributed? What would you attribute to some of that increase, either for self-help specifically, but just credit unions in general, and how can the rest of the industry learn from that?
Yeah, and I would love to do shout out. So we have State Employees Credit Union here. So, and there may be others, but I saw them. And so credit unions have been growing over the last 20 years. It does seem like we're in our heyday, but I do think it is a recognition of the differences between a credit union and other financial institutions, and it being a cooperative, member-driven kind of business model. I think it's also a recognition of the fact that credit unions are able to do a little bit more tailored to their customer, because we all have like a field of membership, right? So whether it's you're serving state employees or you're serving a certain geographic area or a certain profession, it allows you to think about that member in mind. Whereas banks tend to have a lot of more services, a lot more products, and have a much bigger general base. And so it's almost like it's not a buy local, but it's really about what are you looking for out of your financial institution. We find that most folks who are at a credit union are also at a bank, right? They don't have just one, and we're okay with that as long as you do a lot of stuff with us, right? It works for us. But there's just this recognition, I think, of folks becoming more savvy about where they spend their money and who they invest in and who they invest with. And they're now finding us in ways that we have not seen it before.
So we talked a little bit about technology, and the prior panels did also a really good job about the balance and the use of technology. So Antoinette, how do you think about the use of technology while also maintaining that balance for the personal relationships?
Absolutely. Look, it's still needed, both. It's funny because right when we were networking, I think I met with Ashley from Elon, and we shared our LinkedIn via QR code. And so we were in person, but we utilized technology at the same time. So I think that we have done tremendous work, especially in the financial sector around technology. I think that we've nailed down, we're almost there with allowing our consumers to self-serve. And self-serve in a way that you're able to get responses to your general inquiries, whether it's your balance or your statement, or to be able to view your account. And, over the 20 years that I've been in banking, that has progressed. And so I think that we're there. Where we still need humans and where we still need people is around difficult, the challenging inquiries that come in, and more of the problem solving. And we talk a lot about technology, but technology cannot move technology. We need people to move technology, and we need people to innovate to create those new products or create that new area of focus in business. And so we need both today, and we need both to be strong. And so when you're leading a business, we talked a lot about hiring here and development and education. We still need all of that. All of that is needed. And we need trade work too. I mean, I know we had a panel that talked about that as well, but education is still key, and development of our employees, because that gets them to think. And so I know someone was on the panel and they mentioned, well, I could just Google, a response, or I can Google how to do something. But does that allow you to collaborate with others and really truly think about how you innovate and move your products forward? And so we still need both areas, and we still need that relationship piece. Even though most of us are hybrid or virtual environment, we still have to come together and continue to push technology to help support us do our jobs.
Thank you. All right, so one final question for Holly, then we'll kind of wrap up with the final question. Holly, so we talked about inflation and the changing environments. How has your firm navigated the increasing challenges that some of your clients' employees have faced?
Yeah, so the changing economic conditions have been attributed to a decline in overall donations across the entire nonprofit sector in 2022. We went from $516 billion to $499.3 billion in 2022. It's only gone down 3 times in 40 years, and if you read about it everywhere, what it attributes to is, of course, the stock market change and the volatility. For us, we have an earned income model, and our product, as we offer it today, the solution that we offer is paid for by the folks that we work with to support the program that it offers. And so when you think about how that's affected Charlotte nonprofits, Charlotte nonprofit sector is extremely strong. A lot of well-known, well-run leaders in the organizations and in town, but certainly trying to figure out ways to innovate beyond a traditional donation model, because as we've talked about, all these generations are interacting differently with fundraising, and technology is, to your point about the changing expectations of product here, it is absolutely the case to me with the nonprofit sector of how people in the alpha, in the gen, pick a letter, will engage from a traditional fundraising standpoint. Because of the volatility in the world, with climate, with geopolitics, with the financial situation in various parts of the world, and with the hardships that these types of workers face, we, in our business, have not seen that decline, because we're there to serve that need, and that need is increasing. But the idea of taking some of these innovations in technology and looking at where the nonprofit sector folks are on being able to make capital investments, how they pay for those capital investments, who will step up to fund that need, it's a real question mark. Most funders in town and elsewhere do not fund capital projects. So when we talk about technology being at the center and core of innovation, and we even go to artificial intelligence and machine learning, we got a mic drop there. Cyber hygiene practices, got another mic drop. So, we have a long way to go, to me, to figure out how to catch up a sector that is really struggling with even business continuity issues after COVID.
Thank you. So let's try to end on a positive note. So, and let's not forget about the tweeners in the generation. So I'm considering myself an exennial. So there are people who don't exactly fall in either. And I have children who, I don't know, Gen A or whatever the next generation is. And so I don't like it when people fall in the trap of saying the next generation is lazy, they didn't have it the same way. It's just not true. It's not true. There are lazy people in every generation, and there's hard workers in every generation. They just do it differently. So on that note, what can you all, I think we've got to wrap up quickly. What is something that excites you about the future? What is something that's positive in terms of any of the topics we were talking about today that we can leave everyone with?
I would just say I'm continue to be excited about innovation and technology. I'm excited about the work that we plan to do, specifically in Synchrony, and how we are, thinking of ways to support our customers, and just, bringing in all generations of employees, and just bringing new ideas to the table and new ways to service. So I'm excited about that.
I'm excited about finding innovative pathways for social sector funding. Impact investments is something that really intrigues me. It's not used as much here in the Charlotte area by the traditional philanthropists. And so would love to see the corporate community and the traditional foundations in the community open up to the idea of leveraging the other part of their assets, not just the portion they normally donate, to actually move the community forward. The other thing I'm excited about is housing. Affordable housing has got a lot of really cool financial innovation around tax credits and other 100 different ways to make things happen. And I think that might be kind of a cool thing to study and apply to other parts of the sector.
I think I'm excited, or we're excited, that a lot of the things that we've talked about for 42 years is now become mainstream, right? And so it used to be that we would feel like we were the only ones talking about economic prosperity for all, or we were the only one talking about upward mobility, and it was very much of an us or them conversation. But to hear, the panel that's around construction and engineering talking about that, and to hear the panel around workforce and education talking about DEI, talking about the need to address these areas, talking about upskilling, to hear that those themes resonate through all three panels, to me, is what's most exciting, because that means that we're not talking in an echo chamber, but we actually can start to have real conversations across sectors and communities to get the work done to really transform this community into a community that works for everybody.
Well, thank you so much, Crystal, Holly, and Antoinette. Round of applause for our panel, please. Thank you.